location in Heron, Marion, Elko Path, and Harrisburg. So we're super excited to be here today. We're just going to introduce ourselves and then start with insurance, actually. So
I'm Taylor Shanks and I work out of our Harrisburg office primarily, but I do travel around a little bit. I do all customer service things. So I open checking accounts, savings, DDAs, or DDAs or checking accounts, IRAs, CDs, that kind of stuff.
Kelly Green, I'm a loan officer out of our Heron branch and also work with business development and financial literacy, which is my passion. So anyway, we're super excited to be here today. Hopefully you'll have some things that you'll take away that will help you for the rest of your life.
And I'm Eric Widges, the Chief Operating Officer of Farmers State Bank Insurance. Also FSB Insurance is the name of it, actually, DBA. So we're a separate entity of Farmers State Bank. The agency is an independent insurance agency. We have offices in Marion, Harrisburg, and El Dorado. Independent means that we are not designated towards one particular insurance carrier. So we have carrier contracts with 15 different carriers. Unlike a State Farm or Country Companies, they're captives, so they can only write with Country Companies or State Farm. We can write with Cincinnati, with Pekin, with Liberty Mutual, with a whole range of companies to ensure that you're getting the right coverage at the right price. And so we have offices, these 3 offices in Illinois, an office in Florida, and we have a multitude of people in the office. So we have 19 total people in the agency, kind of situated like the bank, where we have some customer service reps or account managers that are your front desk people that are taking the calls. They're the first greet that a person walks in. Then we have some account managers that are working in the back room, doing all the paperwork, communicating with carriers. And then we have agents, kind of like myself, that are out into the public, that are going out, visiting the property, visiting with the people, and ensuring that everything's accurate from the beginning. So that's kind of how our agency is set up. We have a multiple carriers. I know we've talked about Cincinnati and Pekin and Progressive are the main ones. But think about insurances. It's about pulling money together as a whole to ensure that your coverages and your risks are covered. So a risk would be anything like your car, your home, your personal belongings are all things that are within insurance. And so whenever you buy a policy, you're basically transferring the risk of that loss to another third party. So there's 4 things you can do to eliminate a risk. You can avoid it. So if we're looking outside now, we have cars. It's kind of avoid, we drove a Cardinal this morning. It's hard to avoid that risk. But we can reduce the risk by driving 55, not running stoplights, or a stop sign. But that's the reduced piece that, you're going to obey the law. You're going to follow the safety precautions that are in place. So that's the reducing piece. And then the transfer piece is, okay, I bought insurance to protect my car through XYZ company. And that company's agreed if I have an accident or a loss, that they're going to pay for the damages that I have incurred as a result of that. It could be damage to my car. It could be an injury to one of my passengers, but they've agreed as a contract that I've signed with them to take on that damage. The last piece is accepting it, meaning you're not going to insure the property. You're not going to insure the car. It's kind of like calling self-insured. Well, what that does is as they'll talk about protecting your assets from a financial standpoint, when you purchase an insurance policy, you're protecting your assets from litigation and from loss through people suing you or taking you to court or trying to recover damages that you've incurred because of that. So those are the 4 options with insurance. There's a variety of coverages. You've got coverage on your home. You've got coverage on your auto. There's medical coverage. There's life insurance coverage. There's umbrella coverage. So there's a whole wide range of risks that you can insure yourself through to make sure that everything you've worked hard for through college, as a college graduate, you've spent a lot of money to ensure that you've got your degree. And the big thing that you take a step back and you look at your investment as a whole, what's probably the biggest investment you're going to make in your life is probably your home or an auto. That's going to be your largest investment. So why not protect it instead of putting that at risk to one day maybe lose it to a windstorm or lose it to a tornado or a fire? You want to ensure that you have the coverage to be able to replace that piece of it. So those are the big things with insurance is, transferring that risk to someone else so that you're not leaving your assets unprotected. And most people, like myself, if there was a fire, I would not be able to write a check to replace all the damages and all the personal property in my house. So I've entered into an agreement with, my insurance carrier to protect me on that. So the last couple pieces, and I'll pass it on to the ladies, they got a lot more to talk about. What I really would like for you to think about is two things, an umbrella policy. So an umbrella policy covers your traditional policy. So let's say you've got $100,000 limit on your auto and a 300,000 limit. So the most your auto coverage would cover would be 100,000 per person or 300,000 total in a bad car wreck. Let's say that you have, you've made some good investments, you've got a home and you've got a second property. Well, what they could do is come after you and go after those other assets and go after your second home or go after your bank accounts. But an umbrella coverage is basically a policy that goes over everything that you have already and gives you higher limits. So you can get $1 million umbrella coverage or a $2 million umbrella coverage or 3, 4, 5, however higher you want to go, based on what you want to pay. So with the positive and the pro of that is it gives you basically an extra layer of protection in case something does happen, that you've got that extra liability coverage. So I would, recommend taking a look at that. I personally have one. It's just because, we have children and you never know when a 16-year-old is going to jump in a car and may have a car wreck and then it just causes damage, down the road. The last thing I would like for you to think about and just reflect on is life insurance. And life insurance, it sounds morbid because we don't really want to think about life insurance because that means we've passed on and we've left this world. But think about the people that are left behind. So your wife, your partner, your children, how is that going to affect them? So if you're the main breadwinner, so to speak, and you're the one making the money, all of a sudden your salary is taken out of control. How can they pay their bills? How can they continue the standard of living that they have existed with you on this earth? And so a life insurance policy has benefits. It's fairly cheap. You can pay it monthly. It's tax-free whenever it does get cashed out. And it's instantaneous pretty well. So it's not something that gets caught up into a trust and then it's got to be passed down and go through court hearings. It's pretty well, once that death certificate is obtained, we deliver the check to the spouse, the children, whoever it is, and they can take care of that. So there's tax implications with that, meaning we don't have to go to the accountant and have deductions for that. There's estates that a lot of people get into the planning piece where they have a large inheritance coming on, and that life insurance could, in essence, pay the taxes of that estate going forward. So those are two big things that I really see with the excess of cost and excess of liability that's going on. Those are the two big areas that I would really like for you to take a look at.
And I love that
Good.
you brought up life insurance because I think about when you're young, you're healthy and you're able to be insured usually. And sometimes you don't know what the future brings. So if you have health things that come on, you might not be able to be insured or it could be very expensive.
Absolutely.
And you could lock into a lower rate. So I have 3 children at home. They're all young minors. And I have 3 life insurance policies on all 3 of my children. Do I want to think about that? Absolutely not. But when they are older, they already have an insurance and it's very inexpensive for them. And then I don't have to worry about them getting it later down the road.
Yeah. She made a great point. I mean, as you get older and you start having more health problems, the life insurance premium is going to continue to skyrocket. So as you get it at a younger price or a younger age or less health conditions, you're going to have a cheaper rate. Basically, what they're banking on is you not passing away. So as you have more health problems, they're going to increase that because they know that opportunity or that chance of you pass away before may cause them to pay that out. But I think the average cost, and like I said, I don't want to sound morbid, but the average cost of a burial is up close to $20,000 now if you go through the whole process. So, a $20,000, $25,000 life policy, probably $1 a day or $1 a month at the most. So, it's rarely cheap to get that taken care of. I'm here if you have any questions. I know they've got a little banking presentation, but you have any questions for me, I'm here. If you have anything now, we can talk about it.
No, and we can do at the end too, if you
Yeah,
guys think of something. So, I want to touch a little bit on financial wellness and budgeting. That's what I'm passionate about, budgeting. So financial wellness, refers to the state of being financially healthy and secure, where an individual's control over their financial situation can effectively manage their resources to meet their needs and achieve their goals. Sounds great. We all want to be able to do that. When we're financially well, we're better equipped to handle unexpected expenses, pursue opportunities, and enjoy life without constantly worrying about money. So it can also have a positive effect on our physical and mental well-being, relationships, and overall quality of life. I think we can all agree. We want to be able to go on that vacation or do fun things because that's what life's about. So, in January of 2022, the average annual income was $60,000. I really think that sounds about right. So we should be saving 9% of that per year, and that was $5,400. So that's what we should be saving every year into a savings account. Next.
Oh, sorry.
No, you're good. This was yesterday. Okay, so step one in starting a savings or budgeting emergency things. So we're gonna set some savings goals. So let's think about like long-term goals, short-term goals, write those down, really sit down and think about what that looks like. So whether that's building your emergency savings or just saving for a trip. I don't know if anybody knows how expensive Disney is, but saving for that trip. Emergency savings should have 6 to 9 months of your paycheck saved into it. If you were to get hurt, if you're just not able to work for health conditions or something, or even maternity leave, you want to have that emergency savings account ready to go. Aflac, that is something that I do through the bank, our insurance. So if I have the short-term disability one, so if I were to get in a car accident and can't work, Aflac's gonna pay me out a part of my paycheck. Or if I have a baby and go on maternity leave, they're gonna pay me for a part of my paycheck while I can't work. So that's a good investment that I think, I pay into it weekly. And, oh wait, can you go back for a second?
Yep, sorry.
Nope, you're good. This emergency savings account, so it should not be touched. And so the first step is to start that with $1,000 and title it emergency fund. And I do always say, like, if this is something you want to do, I have tons of people at the bank when they come to open accounts like this that tell me I do not want this on my online banking. Like, I don't want to have access to it, out of sight, out of mind. So we just open that account, title it emergency fund. You don't have to put 1,000. Obviously, whatever you can put in that account is going to help. But not having it on your online banking and access to it is great. So creating that budget, so tracking your income and your expenses to understand where your money's going. So you want to account for every dollar. Creating a budget to allocate specific amounts to different categories. So I talk about like my personal budget and how I plan that. Some people have this impression of banks that you can't have several accounts at banks. I don't know where that came from because you can. I have like 7. So my checking account, I have like a main account, I have a bills account, a travel account, and my real estate taxes. So every week we get paid at the bank weekly. I added up all my bills, divided it by 4 and said, okay, this is the amount I need to put in my bills account every week. I set that up on automatic transfer where we get paid Friday. It already happens. I don't have to go in and do it. I think that's like a huge thing of people like having the discipline to go in and move the money and to allocate that where it needs to go. So you set that up on automatic transfer, it's gonna do it for you. So I do that. I know what my real estate taxes are. Certain amount goes into that account every month. It's just, you gotta know where your money should be going. If I left it in one account and just paid things, I wouldn't have any clue where it was going or what it was doing for me. Practice frugal living. So we just talked about, when we did a presentation yesterday, we talked about like grocery shopping. I need to be better about this. So I told them that yesterday. Aldi's a great place to go grocery shopping. I love it there. It's where I do most of my shopping. Also taking an inventory of everything that you have in your house. So you don't buy the same thing over and over again. Like how many bottles of ketchup do we have? Because we don't like look around our house to see what we already have before we go grocery shopping. And to not go hungry. I think we all know that. That's like a rule of thumb. Don't go grocery shopping hungry. And then coupons are great if you're wanting to eat out. I said this yesterday too. Did you guys know a Subway sandwich footlong's $14? Like, it's insane. I said, you remember like 3 years ago when it was $5 footlong? And then now it's $14. So, at the bank, we created this like bucket that will cut our coupons that we get in the mail out and put them in a bucket. So when people want to go eat lunch somewhere, we're like, just take one of the bucket, out of the bucket, the coupons. Subway. You can get a 6-inch for like $3.50. So doing those little things do make a difference and will help you save some money a little bit somewhere.
The last business we went to, they would go on their lunch, it was construction type workers, and they would go on their lunch hour and go to the gas station and spend $20 or more every single day at lunch.
Yeah.
And it's like those kinds of things, if you're on a budget, just don't make sense.
Yes. Or just like meal prepping your meals, or like I talked about yesterday too, having like a cute like acrylic calendar. I know you're gonna want this in your house, but like a calendar for your meals. So that way your family knows you're having breakfast, lunch, and dinner planned out already for the week. Like on Sundays, I love to do that. Sit down, figure out exactly what I'm gonna do, what I'm gonna make, and then set yourself up for success, on Monday. When I don't do that Sunday, I'm like out of whack by Monday. I'm like, what am I doing all week? Then that makes me want to eat out more or just run and grab something. And so just thinking ahead, being prepared for those things helps me save money and keep my peace of mind.
Okay.
Yeah,
And
you're
just to add, can I add just a few
Yeah.
things? Like, I love that she talked about the emergency fund. To me, that's like so important, but also just if your employer offers your 401k, so any budget's gonna say pay yourself first, so definitely don't miss out on that opportunity. And just over the years of working with coworkers, a lot of my coworkers have not put into their 401k. They just don't think at the time they can afford to do that. But the earlier that you can start putting in, because it's the time that you have to grow that money. So if I start at 40 putting into my 401k, but you start at 25 or 28, you're going to have like double the retirement that I am, even if we put in the same amount, because you have the time. So as soon as you can start putting in your 401k, please do that, and do that at least up to your employer's match if you have a match deal. So here at the bank, they match 4%. So I always tell everybody at least put in 4. And then maybe as you get raises, increase that. To me, that's like your number one. And then your number two is emergency. And then those long-term, short-term goals and the fund money is super important. The whole part of that budget seems scary or not fun, but the whole part of it is that you can go on vacation.
Yeah.
You can do fun things as long as you name every dollar and you know where your money's going. So, yeah, I loved it.
So I get the wonderful part about assessing financial decisions. And so it's one of those things, well, what in the world does that look like? Because we've got 19 people in this room right now. And my goal is going to be different than Taylor's. It's going to be different than Eric's. It's going to be different than Christine's. So, goals could be, I want to be successful. I want to own a home. Well, my definition of success is going to be different than Eric's. My version of my home, I could want a tiny home and somebody else might want a mansion. Those $2 amounts are going to look drastically different. So whenever you think about assessing your financial decisions, first you have to understand, well, what are my financial objectives and my goals? What am I looking at? What do I want to do? And saying, what do I want to do in the short term? What do I want to do in the long term? In the short term, I might want to say, I just need to get through college at this point. Long term, I want to get my master's degree, or I want to get my doctorate or whatever, and understand there's going to be a financial impact with regard to that. And how does that line up with my objectives for the future? Most importantly is to weigh the pros and cons. We're going to talk about this in just a minute when we talk about the difference between renting a home and buying a home. But understand that there's going to be positives and negatives for every financial choice that you make. And you need to make sure that you get educated, make informed choices when you're doing those things, and make sure that they always align with what those financial objectives are. So, for example, probably need a car. I would love to have a Chevy Corvette. We were talking about that on the way over. That's my favorite car. Would love to have one. That is a want, but that is not a need. I need a car. So can I get by with a Volt? Absolutely, but still would like to have that Chevy Corvette, they say. So understand the difference between the want and the need. So you always want to make sure that you're questioning your intentions, and be mindful of societal pressures, meaning everybody on your street may have a Chevy Corvette, but that doesn't mean you have to go out and get it. So you just need to make sure, don't cave to everybody. Everybody else has got that Apple Watch. Everybody's got the greatest new phone. Everybody's got this. Just because everybody has it doesn't necessarily mean that you need it. Make sure if you're gonna make that purchase, whatever it is, or whatever you're saving for or investing in, that it aligns with what you're wanting to do for the future. Christine just touched on it just a little bit, but understand the time value of money. I was really hoping that there would be an accounting major in here because nobody loves a great amortization schedule like an accounting major, which that's what I am. It's like, oh my gosh, to get to do an amortization schedule, this is so exciting and what have you. But understand that there is a time value of money. Money is worth more now than it will be 5 years or 10 years down the road. So interest is a two-way street in that you earn interest on things that you invest in or that you deposit into an account. But you also are going to pay interest too, and understand that that is going to, have impact over time as well. You want to make sure that you invest now if you possibly can. Once again, Christine talked about that too. With the concept of the time value of money, with compounding and things like that, if you just start with a little bit now, over time, that will drastically amount to more at the end, whenever you're going to utilize that money, than if you wait. And I wish we had this one slide. It shows the effect of compounding interest when people wait and start to invest and what that looks like at the end. And when people start at the very beginning of their career or whatever, and do it all throughout that time period, it's exponential, the difference on that. So it's so important, even if it's $1, if it's $5, whatever you can put back, just make sure you put something back now. Make sure that you get educated. So gather all the relevant information for the choices that you want to make. If you're looking for a home, you want to research your market. You want to make sure that you research the institution that you might deal with as far as to get a home loan if you need one. You want to make sure that you look at fees. You want to make sure that you gather all the different things that you need to have to make that good decision, weigh those things out, put it on a spreadsheet. Once again, just, spreadsheets. But make sure you analyze that information and make sure that it's relevant and compare that and be sure, once again, that it's aligning with what your goals are. It's not going to be right or wrong. It's just going to be a matter of whether or not it fits within those financial goals that you've set for yourself.
One thing about buying a house that one of our coworkers realized, he was getting married, him and his wife were going to buy their first house. Price point for their house was really, really good. They could afford that. Really nice neighborhood, everything. But the real estate taxes were insane. He was like, I cannot afford to pay those real estate taxes every year. So they couldn't buy this house because he knew he wouldn't be able to keep up with real estate taxes. So that is something that I didn't really think about either when I bought my home, like the area that I was moving to check that out. So.
Yes. The next thing is make sure you create a budget. So Taylor talked about that just a little bit. How do you do that? How do you create a budget? One thing I would say to do is this: if you have an online banking application with your account, many of those now are smart and they understand when you go to the grocery store, it sees Kroger and says, oh, that's groceries. Or if you go to Walmart, it's like, that might be a miscellaneous expense. Or if you go to Not One, it understands that it's gasoline. But the other thing, and this is, it seems antiquated, but the easiest thing to do is get a little notebook and write down every single penny you spend everywhere for at least a month and track that. And so yesterday in the presentation that we gave, one of our coworkers said that they were surprised at the amount that they spent on skincare every month. When you actually see it in black and white, it's very shocking sometimes to realize, oh my gosh, I've spent this much on this. Okay, do I really need that? Is this a want or is this a need? And that will help you identify those wants and needs as well. But I highly encourage, no matter what method you choose, make sure you track those so that you actually can create that budget. Avoid making emotional decisions. So Taylor indicated, we don't go to the grocery store when we're hungry because that's going to go down a path that we don't want. We'll have every Oreo cookie and every Dorito that there is in our shopping cart before we leave. But the one thing I would say that's truly impactful, and I see it now as repercussions from years ago, when we were all going through the pandemic, we couldn't do anything, couldn't go anywhere. And people sat in their house and watched the Home Shopping Network and they watched QVC. And they got online and they got on Amazon and they bought everything because like, well, I can't do anything else. So I'm gonna do this. And so now the impact of that 2 or 3 years later is huge amounts of credit card debt, huge amounts. To the tune of like, $50,000, $60,000 worth of credit card debt because they did all these impulse buys. They were emotional. It's like, I'm so upset because I can't go do something, so I'm gonna do this instead. Don't do those emotional, make an emotional decision. Think about it, sit on it, sleep on it, whatever you need to do. And so the repercussions of those decisions is that now people are having to use the equity in their homes and things like that to try to get that credit card debt paid off, because now the interest rates have all gone up. They're at 30%, 25%. And it's crazy. They can't make the minimum payments for those things anymore. So it's truly impactful. Yes, it would be nice to buy, I don't know, that wonderful towel set or whatever. But you
What?
don't need $100 in towels. We just
Oh,
need
towel
what you
set.
need to have. So anyway, just make sure that those, don't be emotional when you're buying. And lastly, understand that there are opportunity costs. For every decision that you make, you're gonna have to give up something. And we're gonna talk about this specifically when we're talking about renting and buying a home. If you decide that you're going to buy a home, then you also need to understand there's gonna be other things that come along with that you're gonna have to give up potentially. You're gonna have more that you're gonna have to spend with maintenance and things like that. Where if you rented, you have extra money at that point that you can put back towards savings, or you can put back toward that Disney vacation or whatever. There's a cost for everything that you do. So just making sure that you understand, oh yeah, I'm gonna go buy a house. Okay, but there's still gonna be taxes, there's gonna be insurance, there's gonna be, somebody's gotta mow the grass, whether it's you or someone else. There's other opportunity costs, there's other things associated with it other than just your house payment each month. So how do we become good with this? It just takes practice. Just you make sure and always go and take a look and back check on like, how did I do? Okay. You take a look back at your previous month and say, okay, kind of blew it here. You need to get this back in line, reassess where you are and just continue to move forward. But at the end of the day, always make sure that you've said, okay, this is what I want to do. This is what I want my house to look like. This is what I want my car to be. Is what I'm doing are the decisions that I'm making in line with those choices that I've made.
I think a big part of that too is just, we, in our presentation yesterday, talked a lot too, just about self-discipline and like maybe an accountability partner, whether that's your spouse or your partner or your best friend or someone just like checking in with you and holding you accountable to whatever your goals are, and just making sure that you have some self-discipline and things, especially like people with the credit card self-discipline. There was a lady yesterday that was like, I just can't do it. No way. I cannot have a credit card. I can't do it. And I was like, okay, well, at least you have come to terms with that. But
She understands her strengths and her weaknesses, and that's how you move forward at that point.
yeah,
And if you can have control of your credit card, it is a really great way to, build credit and to keep
Yes.
credit. Like it's a great
And
line of credit to have as long as you pay it in full every month and pay it on the due date on time. It's a great.
yes, it's a great tool.
Save
And all
those
things need
credit.
that. Her example yesterday with the credit card was she got herself in a bind and finally had gotten her credit cards paid off and such, but she needed to rent a car. She didn't have a credit card to rent a car. And then they would, like with her debit card, they wanted a Ameren bill and like something else. And her Ameren bill is in her landlord's name because she rents. So like this lady was stuck with like no way of renting a car because she didn't have the credit card. So
And I think that's why I'm looking like at this age group, a lot of people that I see that are in their early 20s, they're scared of credit cards. They really don't know about them because we've always said they're bad, bad, bad. But really, they're a great tool as long as you know how to use them and you have the discipline to be able to choose. So I always say, just put on your credit card an expense that you're used to purchasing that you can afford. So like your gas, put your gas on your credit card every month.
yeah, that's
And
what I
then
say
that's
too.
a good payment history and that builds your credit, and keep that credit card for 10 years plus. Because time and a line of credit that you have that time that you build is really great for your credit.
Yeah.
But yeah.
Thanks, Helen. Sorry.
You're welcome. All good things. So to get right down to the brass tacks, and this is one of those things that I think is truly impactful for college students, because you're coming out into a workforce now. And you're gonna be moving, possibly relocating, and you have to think, okay, do I want to rent or do I want to buy? And there's so many different things that you don't think about whenever you're talking about purchasing a home. The number one thing you need to think about is, what your financial situation is. And most people do not have $200,000 sitting in an account when they're coming out of college to go out and buy a house. If you do, that is fantastic because somebody has put money back for you or you've been a great saver over the span of your lifetime up to this point. So number one, you have to understand the fact if I'm going to purchase a house, I'm going to have to probably have some sort of a down payment or some type of emergency fund there or some type of fund that I put money in for a little bit of time to be able to do something with the down payment. The other thing that you need to think about is, what is your income going to look like when you're out of school? And you have to, as a loan officer, I'm going to look at this and say, what is this person's debt to income ratio? So what is the total amount of debt that they're carrying? And they do look at education loans as a part of that as well. But we want to say, what is our debt? What is our income? And the ideal range that we try to stay in within our policies, we will not go above 43% debt to income ratio. Because you have so many other things, groceries and, your car insurance and things like that are going to take up the rest of that money to make sure that you're not putting yourself in a situation that you will fail. And then as we just talked about just a little bit with regard to credit, what is your credit score? Many secondary market financial institutions that we deal with, there's a minimum score that you have to be able to get that loan. And normally that's somewhere around that 680 range. If it's below that, you're going to end up paying a premium on your interest rate for your home. You may not be able to get it. So you need to make sure that you maintain really good credit. And one of the things I always, if I'm in high school classrooms or whatever, I make them promise and swear that people will do this. Go to annualcreditreport.com. That is the one website that is sanctioned by the government for you, and they mandate that the three primary
The credit bureaus were.
you can get your credit report and see what's out there. And what I would suggest that you do, and they have to provide that to you for free. Make sure you go out every 4 months and you check Equifax, then you check Experian, and then you check TransUnion. And you make sure you see what's out there because with the different types of breaches and things like that occur, just because you swiped a debit card or whatever, that every time you swipe that card, it captures information. If somebody steals that, you're at risk of identity theft. What do people do with that? They open up accounts. So you want to make sure that you don't have something out there that you're not aware of. It happens. I'm working with a customer right now trying to help repair her credit because she's a victim of identity theft. She's trying to file disputes. She's trying to do all these different things. It's falling on deaf ears. Short of falling, getting in with the FBI or something like that, she's at a loss at this point. So now she's having to fix her credit. So with that having been said, make sure that you're diligent and making sure that your credit is good. Make sure you don't have anything out there that's not yours. And the way that you can do that is check that creditreport.com site and you can access those credit reporting agencies and find that information. But if you do that every so often, you get a picture in time of each one and you make sure that nothing has happened. It's not going to give you a credit score unless you actually make you can sign it to get a payment, for you and make a payment, have that provided to you. A lot of people use Credit Karma. A lot of people use apps from their credit cards and things, and that's great. If that will show you what your debt is out there, that's fantastic. Just make sure you know what it is that you've got out there for your debt. And then also understand when you are looking at buying a house, you're always going to want to keep a certain amount of money held back in that emergency fund. And we see this happen all the time. Somebody has saved up $15,000, $20,000. They put that down for a down payment. They're in the house for 3 months, and guess what happens? The furnace breaks. They got to replace a furnace. And the furnace, I don't know if anybody's had to replace one. Taylor?
7,800, and that's just on my home. That's like 1,500 square feet. So
They're not cheap. So
Yeah.
that
a
is,
brand new one on a brand new build, like our coworker, was about 12,000. So
they wiped out their down payment, or they wiped out their emergency fund with their down payment. Now they don't have anything to do with that. So now they're scrambling. What am I going to do? So always make sure that those initial costs that you're going to have with buying that house, and are not going to completely wipe you out from an emergency fund standpoint. One of the things that one of our coworkers did, and I actually did find this out on a website too, is a calculator. And I'd be happy to share that so that people have access to it. But it's actually a spreadsheet where you can key in information and say, okay, if I move to Nashville, Tennessee, this is what I'm looking at as paying for rent. And you can talk to a real estate agent or someone like that. They can give you market trends, what interest rates look like, what housing expenses look like, what maintenance looks like. You can key in those pieces of information and actually look at it in black and white and say, okay, in Nashville, Tennessee, it makes more sense to rent as opposed to buy because it's exploding down there and the price of property is outrageous. But if you move to Darby, Montana, it might be a little bit different. Probably would be easier to buy a house at that point. But I'd be happy to share that so that people can have that to do a little calculation. One of the most important things to look at when you're trying to evaluate whether to buy or rent, where are you going to be? Am I going to be in a year, 5 years, and where am I going to be in 10 years? So I like to pick on my oldest child. He works in St. Louis and he works for a plant up there. And he has tossed around the idea, do I want to buy, do I want to rent? And for him, with his lifestyle, he's not exactly sure where he might be in 5 years. So he's made the conscientious choice to say, I'm going to rent until I know for sure where I'm going to be. And that way, if he has to pick up and move, he can go. He's not tied down to that house. So you might have a little bit of a lease to deal with. You might have to have a sublessor or something like that to take care of that. But in his mind, it makes more sense to not have to worry about, oh my gosh, how am I going to sell a house, buy a house, do whatever. I just have to worry about my next job and what I'm going to do there.
Have you looked at any, like researched any houses or properties or anything for if you move back up north? Yeah, rent.
Just make personal connections.
Yes. And maybe the market will change in a couple of years and interest rates won't be so high and stuff like that. But I was just curious.
Yeah.
And you touched on this, but a pro for renting is like if you're really busy starting up a business or working like the one that we just recently, he's going to medical school and he's gonna work 24 hours on and 24 hours off. He has a brand new baby and I mean, he's probably not gonna have time to do maintenance on his home. And that's a big pro for renting. You
Mhm.
don't have to worry.
If you're, yeah,
Because that was my next.
yeah, if your HVAC unit goes
Because
out,
If you're gonna buy a house, you're probably gonna be doing some DIY at some point in your life. Or immediately when you purchase that home. So, take a look at what your preferred lifestyle is. Do you want to spend the weekend mowing grass? Do you want to spend your weekend working on landscaping projects outside when it's pretty? Do you want to put that sliding barn door that you see with, what is it, Magnolia or whatever?
Mhm.
You want to do those types of projects around your house.
And if you answer yes to that, that's great. But if you answered no, then I'm like, that's me. No, great. Then now I have to pay somebody else to come do that stuff for me. So
Exactly.
this is when you learn to have friends who like to do those things that you don't like to do. Jared being one of them.
There's no right or wrong. It's just a matter of figuring out, okay, what does my lifestyle look like?
Yeah.
What's gonna match up best with my goals and what I want to do? You want to have a quality of life, life is short. You want to make sure that you enjoy it as much as you can. And if you hate to mow the grass, why would you buy a house? To a certain extent, because, or you pay somebody to do it. But why spend your time doing things that you don't like to do? Understand too, that there's gonna be risks either way. The risk for renting would be, okay, you could get evicted. Your landlord might decide to end the lease. They might decide they want to sell the property and not mess with it anymore. And that happens a lot around here with homes and such as that. Your finances could change. So yes, I just got this job and I saw this happen a lot with people during the pandemic too. With the timing of when that happened, a lot of people got out of school, they bought a house, and guess what? The pandemic hit and now they're out of a job. How do I make that mortgage payment? Yes, you're still gonna have a rent payment, but that mortgage payment's gonna look a little bit different, and it's also something that can absolutely trash your credit. And if you made a commitment to buy that house, it's most likely gonna get repossessed, and so it's gonna affect your credit for years after that. So just understand what your lifestyle looks like. What are the costs associated with purchasing a house? We talked a little bit about a down payment. What does a down payment look like? It can vary. There's different programs that people can participate in. They can have 0 down payment. You can have 5% down payment. Ideally, with most institutions, if they're gonna hold it in-house, then it's gonna look like 20%. Make sure I'm not going over.
Yeah, I was gonna say about 15.
But it may depend on what you have saved, but know that that down payment amount is gonna look somewhere between, probably 1 to 5% to 20% down. Closing costs, I am amazed at what amounts, or what those amounts look like around here. And a good frame of mind to get yourself to get used to that is going to be 2 to 5% of whatever your home is going to cost. It's going to go toward closing costs. And then people are like, well, what are closing costs? Well, that's going to be any kind of fees that are associated with the bank that, or the financial institution that you use. You're going to have title work to transfer the title from one person to the other to prepare that deed. You're going to have an appraisal that needs to be done because you want to make sure the value of the house is there. You may have a home inspection that's done. There could be some other things that come into play with that as well. You're going to have the transfer of taxes. You're going to have prorated taxes. There's lots of little things that come in with that closing cost amount in there, but it's usually somewhere around $3,000 to $4,000 at least just for closing costs alone.
You feeling good about life now? You're like, my renting sounds really good.
And then, so if you don't have that large chunk to put down for a down payment, you're probably gonna have a private mortgage insurance. So that helps subsidize that amount. So it's gonna be a little amount that helps take care of that just in case something happens. You don't have a lot of equity, whatever, it's subsidizing that lack of down payment. And then you're also going to have your insurance and your property taxes and the maintenance on the property itself. So when we get down to actually looking at the pros and cons, for buying a home, you're gonna have, hopefully the home will appreciate in value. And a lot of people look at this as an investment. I'm gonna buy the house and then I'm gonna sell it and buy another house. And then continue to have the value of that property that you purchased continue to go up. So it becomes a little bit of an investment vehicle at that point. Hopefully you're building equity the whole time that you're doing that. With the ability to buy a house, you have the customization piece. I can paint my whole house pink if I want to. Your landlord may not want everything to be pink in the property, knowing that somebody else is going to rent it at some point. There are some tax benefits to owning a home. You have your interest that you can take for your income taxes, some other things that may be pertinent to one particular area or one particular state that you want to be aware of. And that would be definitely something to ask your realtor as you're looking for a home as well. And then you have the stability. I know where I'm going to be. If the cons are the financial risk, you could lose your job. There's also market fluctuations. That happened around 2008. Price of the property went way, 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 way up. And then all of a sudden people realized all these properties are overvalued and the housing market changed at that point. So people were upside down on their mortgages and that was not a good place to be either. Also understand that there's maintenance costs associated with owning a home, what you talked about, got to fix that toilet, you got to mow the grass, you got to make sure that, your siding's good or the exterior of your home is taken care of. Eric, what's the thing going on with insurance right now?
Replacement. Yeah, replacement cost of roofs. So, the big thing in insurance right now is they're starting a rating scale. So if your roof is X number of years, you're only gonna get 1% of that replacement value of it. So if it's a 30-year roof and you're at 15 years and you have roof damage, you're only gonna have 50% of your damages paid for. You've got to come up with the other 50% of it. So it's very drastic. The other thing is replacement costs. You've seen a huge drastic increase in home insurance is because we did a figure the other day we did a Marion comparison, just in Marion. A home in 2020, the replacement cost was $319,000. In 2024, the replacement cost is now $662,000.
Oh
Same
my
house.
God.
So in 4 years, the replacement cost basically is doubled, which you can only guess what happens to the insurance rates at that point. It's
Yeah.
gonna go through the roof too.
I
So
think that becomes a good point. You really, really can't shop for the best rate anymore on insurance. Or the cost, you
Mhm.
gotta know what is your coverage. So if you are shooting for that best rate, you gotta make sure you're comparing apples to apples. But more importantly, something happens, you gotta make sure you're covered on your home. So it's really what kind of coverage am I getting opposed to what's my price?
Yeah.
And you get that a lot, I'm sure.
Yeah, and then like Kelly was talking about the purchase of a home, he's talking about closing costs, and he's talking about all these fees. A lot of people, when they go to buy a house, when they go to get the quote on the home insurance, they about fall over. Because, well, I only paid 300,000 for that house. Correct, that's the market value of the house, but to actually rebuild that house would be probably more in the $450,000. So the insurance is, they have standards and protocols they have to follow as well. If a house is worth 450,000, they just can't just insure it for 150,000 and say it's covered. You know, they have auditors as well that come in and look, are they correctly identifying property values? So there's a lot goes into it, and that makes as well.
Right now, we're in a unique time too. There's a couple different ones I've got going that are construction. And the number one thing that we tell people as they've gone down that road is this. Whatever you're getting ready to put into this home is not going to be what it's worth. So an appraiser is gonna go out and take a look at on the final inspection and say, okay, you know, you may have put $250,000 in labor and materials in that house, but it's only worth $200,000 because it's just a weird market right now. Construction costs have gone crazy, once again, post-pandemic, what those costs are for the materials or the supply chain issues and still trying to get things where they need to be are still causing an impact on those costs that are associated with building something as well. And then you have just additional expenses that come into play, you know, if you decide that, you know, I want to remodel, I don't like this part of my house, I want to take care of some things. That's going to be that additional piece on that.
And then one more thing, like when you're purchasing a house, this is gonna be my plug to use a local bank, but we had a customer in Harrisburg that texted me on her day of closing, or it was the day before she was gonna close, and she's like,
I was just.
I have $8,000 in closing costs, and she had used an online mortgage closing company, and we started talking, and it was really too late for her because she had already done title work, appraisals. I mean, she wasn't gonna be able to, but my point is, she got a really good rate online. She used it.
Rocket Mortgage is who
I think
she
it's
used.
Rocket Mortgage.
Yeah.
And, so it looked really good, but in the end, they had like a $6,000 fee that was not closing costs. It was just a fee to them that she was gonna have to pay. And so sometimes the best rate really ends up costing you more in the long run. And so when you're shopping to purchase a home, any type of loan, make sure you read those disclosures, but it's nice when you use a local bank, somebody that you can trust, that you can walk in person and talk to, that you understand your situation. They're not gonna do that to you. So
Yeah.
you gotta be careful with the online.
Just real quick, the pros of renting are gonna be, most of the times with your rent, your utilities are gonna be part of that, so it's gonna be a very fixed amount of money toward that housing cost for each month. It's either pick up and move, generally you don't have maintenance cost. You can have that opportunity to save money for a down payment, and you can also save that money for other things like paying off debt and the other goals. And then to understand the cons of renting are, you're not building equity anywhere, you're not building up that investment egg that you have for, you know, when you retire. You've got limited control on what you can do. The landlord could, you know, sell that property and there's a less sense of stability. And you may not feel like, okay, I'm constantly on the move or I'm constantly doing something because I'm renting. So anyway, that's that. Questions for about anything that was talked about today?
Or your best takeaway that maybe you were like, wow, I never thought about that, or I didn't expect that.
And we have
Anything?
prizes.
Right, yeah.
Well, thank you guys for your attention. There are